Good afternoon and welcome to the latest in our series of webinars with ActivTrades, hosted by myself, Darren Sinden. Today we're going to look at the idea of whether a market is risk on or risk off and how we can determine the tone of the market. For those of you that haven't joined my webinars before, I'll just say a little bit about myself. I'm an independent analyst and market commentator with over 35 years of experience in the markets. Started on the London Stock Exchange floor when I was 18, and I've had a wide range of roles and involvements ever since. One thing I will say is that despite those long years of experience, every day is still a learning curve, and that's why webinars such as this are useful, because we're able to go over things that do work, things that don't work, and ways that perhaps we can use indicators to aid our trading, which in the end is what it's all about. So before we get into the meat of the webinar, we need to go through some compliance points, and so please do take the time to read this risk disclaimer. CFDs are, of course, complex instruments, and they come with a high risk of losing money rapidly due to leverage. You should consider whether you understand how CFDs work and whether you can afford to take the high risk of losing your money before you start trading them. So as I say, please take the moment to read that risk disclaimer fully, and we'll show it again at the end of the webinar. So where are we going to start? Well, let's start with perhaps a strange place to start, but with indicators that used to work. What used to tell us whether markets were risk on or risk off, and as we'll see, they're well, we'll see what we'll see. But here we go then. Our first chart here is a chart of 10-year T-note or Treasury note futures from the US. This is the December 22 contract, but we've taken it back using the magic of charting to take us all the way back to the early to mid 1980s. The T-bond futures price is shown in the red line, and the green line is the dollar-yen FX rate. So US 10-year T-bonds were seen as the ultimate risk-free asset class, whilst the Japanese yen was seen as a highly liquid bolt hole in times of financial stress and uncertainty. And that was definitely the case when I joined the markets in the mid 80s, all the way through, as we can see, until 2018, 2019. But since then, I'm afraid things have changed. Now, it was the case that traders used to be certain that they could get their money back from either an investment in T-bonds, 10-year notes, or putting their money into dollar yen. And money went into these instruments when people were uncertain or unclear about what the future held. And so, markets were clearly seen to be risk off if we saw a strengthening yen and rising T-bond prices. However, that's no longer the case. And in fact, the exact opposite is happening now. US 10-year T-bonds now yield just over 4%. That's partly a function of the strength of dollar index and also rising US interest rates. That 4% yield that you can get at the moment from a 10-year note is up from 0.5% in March 2020. So in a little over 2.5 years, we've seen an 8-fold rise in the yield on US 10-year Treasury bonds. That's an unheard of move. And at the same time, because of the strength of dollar index, which is up around 16% year to date, we've seen a commensurate fall in the yen. So here, dollar yen again in green, and of course, the higher the number, the weaker the yen. This chart's set out to show us the percentage change. So the yen has weakened 13.93% over the last 6 months, while the price of US 10-year notes has fallen by some almost 7.5%. So these are now no longer instruments that we can rely on to be a guide to whether the market's risk on or risk off, and so we've really got to park them for now. Whether they'll come back remains to be seen. I think in this period of higher interest rates, T-bonds certainly may start to look attractive from a yield basis, but there's no guarantee that they won't be cheaper and yielding more come next Thursday morning after the FOMC, for instance. As to the yen, holders of the yen are lucky to get anything but the most marginal yield from the currency now. And to my mind, the yen appears to be in some kind of slow motion free fall or car crash. And it's not that clear what the Bank of Japan can do to stop it falling further, if indeed it actually wants to. At the moment, of course, it seems to be focusing on controlling the yield offered by Japanese government bonds rather than trying to defend the currency. So that's what used to work, what doesn't seem to work. Let's move on to another gauge of risk on, risk off, and perhaps the best known one, and that's the Chicago Board Options Exchange, the CBOE VIX index. As I say, perhaps the best known gauge of market sentiment, and it's a measure of I've spotted a typo here. I put the impaled volatility. That, of course, should be the implied volatility in the options of the S&P 500 constituents. It's often described as the greed and fear index. Just a quick word about what implied volatility is. Implied volatility is a measure of the expectation of a large price move in the underlying instrument. So in this case, the VIX is really telling us what the expectation is for large price moves within the individual S&P 500 constituents, and therefore within the VIX index itself. For many years, this was a very good gauge of risk off and risk on behavior. Markets were seen to be risk off when the VIX index traded above its 50-day moving average. And it's the 50-day moving average that we plotted here in red against the VIX index in black, and in the bottom window we've got the percentage that the VIX is trading above or below its 50-day moving average at a particular moment in time. Where it dips into the red, we're below the average, and where we see green shading here in this lower window, we're above it. Now we're well above the 50-day moving average. When I drew this chart, we were almost 8.2% above that benchmark in the VIX. However, I don't think anybody would call the current market risk off. We've had a couple of weeks of very strong equity markets, and so to some extent, the ability of the VIX to determine the mood of the market seems to have faded away. For the moment, the VIX itself looks pegged, to my mind, to the area around 30, given some of the moves we've had well, not just in recent weeks, but in this year. We might have expected it to have rallied further. That hasn't been the case. So for now, at least, the VIX again is probably sidelined as a measure of greed and fear and or market sentiment, stroke risk on, risk off. And so with that in mind, what else can we look at that can tell us how the market's thinking and what likely direction it may move in? Well, we can consider some alternative indicators, and here we're going to focus predominantly on indicators for equity markets, as they're the ones that seem to be the most obvious indicator of risk on, risk off, and the ones that are being driven by the so-called animal spirits in the market. It must be said, though, that at the current time, sentiment is really the key for driving the markets, and that can swing very, very strongly. We saw that last Friday afternoon, for example, when the Wall Street Journal published an article suggesting that the Fed may hike 75 basis points next Wednesday, and then may pause for breath and consider what it does thereafter. So that Fed pivot narrative doesn't want to die, and it was very warmly received last Friday. I think we're getting a little bit less certain about that from today onwards. You can see the US markets were ticking down in European trade, and the countdown till next Wednesday evening is continuing. But perhaps some of the indicators that we'll look at in these next slides will allow us to gauge just what the market is thinking as we approach the FOMC next Wednesday, and not forgetting, of course, non-farm payrolls for October, which will be out not this Friday, but the following Friday. Okay, so one area that we could look at and probably should look at to determine the mood of the market is so-called high beta stocks. Now, stock returns are basically divided into two portions, shall we say, under sort of classical market theory. One is called alpha. Alpha measures the idiosyncratic or unique factors within a stock that drive its price. And the other is known as beta. And beta is a measure of a stock's volatility or sensitivity, if you will, in relation to the overall market. And so by definition, the market, an index such as the S&P 500 or the NASDAQ 100 has a beta of 1, and individual stocks are ranked and graded according to how much they deviate from the market. So how much more sensitive they are to a move in the market, a certain number of index points up or down, and through a little bit of math, we can come up with a ratio or a figure that expresses that. Now, the table on the left-hand side here is of the top 20 highest beta stocks within the NASDAQ 100. The NASDAQ 100, of course, is probably the most risk-on index, and these high beta stocks are the most risk-on stocks, if you will, within that most risk-on index. So our first highlighted column just shows you what the beta for each of these stocks is. So Tesla, won't surprise you to learn, probably is the highest beta stock within the NASDAQ 100 index, and that can be expected to move 2.11 times for every point in the NASDAQ index moves. And of course, that works both in on the upside and the downside, because all the beta is a measure of its sensitivity. It says nothing about the directional movement, just gives us a benchmark for what we should expect from those stocks. And of course, we can see that the lower beta stocks within this top 20 are at the bottom here: Amazon and Workday 1.33 and 1.32 as their readings respectively. So how can we use that beta ranking to gauge what the mood of the market is? Well, one way I find useful to look at this data is to consider what the 5-day changes within those high beta stocks. And yet we don't necessarily need to look at the individual moves, although it's quite telling, I think, that Tesla is down 3.69% over the prior 5 days. This was drawn yesterday, by the way, so it doesn't include today's moves. I think that, as I say, that's quite telling in itself. But what I would take away from it more than that is just at a glance at which way these stocks are moving, and predominantly those stocks have moved higher and continued to move higher over the prior 5 days, which I think gives you an indication that the market at that point in time was feeling pretty strongly risk on, and indeed we saw a decent move higher in US equities yesterday off the back of readings like this. And again, the reprise of that Fed pivot narrative, which is gripping the market so strongly. So the 5-day change in high beta stocks within the top 20, or you could extend it to the top 30 highest beta stocks within the NASDAQ 100, or indeed within the S&P 500, is certainly something to keep an eye on. Now, I always want to stress that the information and data that I use in these webinars is drawn from publicly available sources. I do pay for market information and price display, but the services I use tend to have a freemium element to them, if you will. These tables are drawn from barchart.com, and as I say, they're freely available. You don't have to have an account. You can even register for an account for free. There's no obligation to spend any money there, and there is some very useful information and indicators available on that site. Okay, so what about looking to other markets for indicators as to how and what the mood of the equity market is? And one place that we can look for that is within the equity options and equity options index markets. And they provide us with a number of useful indicators, one of which we'll look at here, and that is the equity put call ratio. Now, this is a ratio that once again comes from the Chicago Board Options Exchange, the CBOE, the very same people who created the VIX index. The put-call ratio is another measure, I guess, of greed and fear, of market sentiment, and therefore risk on, risk off. And what the put-call ratio measures is the amount of put option buying relative to the amount of call option buying in the market. And so effectively, it's the number of puts purchased divided by the number of calls purchased over a given period of time. Just to expand upon what put and call options are, in case any of our viewers today are not familiar, put options are a derivative that confer the right but not the obligation on a buyer, allowing them to sell a fixed amount of an asset at what's a known strike price over a set period of time, for example, 3 months, but the options can run for 3 months, for 6 months, for 9 months, for a year, or even weekly, or just over a matter of a few days these days. Call options then are the opposite of put options. They confer the right but not the obligation to sell a fixed amount of an asset, typically a stock, at a known strike price over a set period. Again, that period could be 3 months, could be 6 months, could be a year, could be 1 week. The key point about the put-call ratio is that the more put option buying there is, then the more defensive or risk-off the market is seen to be, and the higher the put-call ratio will be. And what that basically means for us in practical terms is that if the put-call ratio is above 70, then the market is very much risk-off. And you can see I've drawn a line here. Well, I've actually drawn it slightly above 70, but basically to indicate the boundary at which we could consider the market to be risk off. You can see how high the put-call ratio spiked here as we had the COVID sell-off in the spring of 2020. This, by the way, is a 5-year chart, so this is quite condensed, but it is possible to view this on all of these different time frames, ranging from 5 years down to 1 day. Now, again, this is an indicator that you can pay to receive, but it is available for free if you know where to look. So in this instance, I've taken this chart from ycharts.com, and at the bottom of the screen here, you'll see the link to that, ycharts.com/indicators/CBOE_equity_put_call_ratio. So again, a free indicator, but one that can prove very useful. Now let's look at that chart in a shorter time frame. And here I've drawn the put-call ratio over just 3 months. And again, I've put in a barrier slightly above the 70 level, to be fair, but it's to indicate where the risk-off portion of the market is, according to this indicator. But perhaps more importantly here, I've drawn a downtrend line, and that downtrend line shows you that in the last month, since the 27th of September, the put-call ratio has been declining, and that coincides with a 4.5% and slightly more actually after yesterday's close rise in the S&P 500. So reference to that probably on a daily basis is a good starting point to try and determine where the market is currently basis the spirits of risk on and risk off. Although, as I say, that needs to be tempered by trying to get a flavour of market sentiment and how and what catalysts or support there are for that current narrative, or indeed any narrative, but the one that we're most being shaped by at the moment, this idea of a Fed pivot post-November. Okay, well, what about breadth indicators? What can they tell us? Market breadth is a very interesting concept, and it's one that perhaps is seen as being old-fashioned, but what we're really trying to measure when we talk about breadth is participation. How much or what percentage of a market is involved in a particular move? Is it a broad-based move? Is it a move that's being led by just a few stocks that are moving perhaps in an over-exaggerated fashion in one direction or the other? And how much volume supports that move? And can we get a gauge of what stocks are doing relative, say, to period highs, period lows, etc., etc. So indicators tend to come in and out of fashion markets are, you know, no different really to any other environment. Things are fashionable and popular. They become buzzwords and are widely used, and then they're dropped at some point for an obvious reason, perhaps like the T-bond and dollar yen series that we looked at earlier, or sometimes they just fall out of fashion and people move on to something else. But breadth, whilst it's not on everyone's lips every day, is in my opinion, one of the best indicators we can have about how a market's feeling, what the participation is, and you know, what that can tell us. So we'll start with a chart or a table from Tuesday. Again, this is taken from barchart.com. It's their stock momentum page, but it's packed with information. Bar chart is US focused, and though it does cover foreign markets, European and Asian markets, most of the data is about the US, but that's okay when we're talking about equities, because the US equity market now accounts for almost 60% of global market cap. So what happens in the States is very much, you know, it's very much the market that takes the lead as far as global equities are concerned. So let's have a look at this table and have a look at some of the information that's contained within it. And it is very much a case of being information rich, I should say. To start with here, we've got the data from the New York Stock Exchange and then separate data from the NASDAQ. This is as things stood on Tuesday morning. Market was up on Monday, as you may recall, but in this instance, the volume on the buy side, the volume in green, wasn't that much bigger than the volume on the sell side here in red. I mean, it's a 60 to 38% split, with just 2% of issues unchanged. Yes, it favoured the buy side, but it wasn't dominating, if you like, or completely convincing. And that was also the case here on the NASDAQ, where we see almost a 50-50 split, or you know, or very close to it. In fact, if we're going to be pedantic, there were 49% of NASDAQ issues declining in Monday's session, as reported on Tuesday morning, compared to just 48% that were rising. Now, overall, the S&P 500 put on just under 1.2% on Monday. But this will, as we'll see in the second half of the table, was a less than convincing display. The second half of the table concerns itself with the number of stocks that made new highs and lows, and obviously that's a brilliant gauge of market sentiment, because if people want to buy or sell an index or the stocks within it, then we should see stocks move. We should ideally see them making and posting new highs and new lows. So as far as new highs and new lows were concerned, in total, then we had 80 new 5-day highs and 175 new 1-month highs on Monday's session. But if we go out into further time periods, we find that there were plenty of stocks that were still making new lows. In fact, net on Monday, we saw 339 new 3-month lows and 265 new 6-month lows among US equities. Now, if we break that down, we can have a look as to where those new highs and new lows were posted. There were more new highs in the NASDAQ, sorry, in the New York Stock Exchange, 355 new highs in the 5-day period on Monday, and 303 over 1 month on Monday. And then, as we saw in the combined stats, that falls away, and anything over 3 months, there were no new highs. Simple as that. And for the NASDAQ on Monday, there were no new highs at all, or no net new highs at all, I should say. In fact, all the differential columns here are in the negative territory, and many of them quite heavily in negative territory too. So more new highs, more new lows. Although the market went up on the day, it's not a very convincing picture, is it? And so the best we could perhaps say about that session is that the market was tentatively risk on. Now that took us obviously into Tuesday's session, and there it was a completely different story. This is that same table as of this morning, the 26th of October. Yesterday we saw the S&P 500 at 1.63% and the NASDAQ up 2.25%. And as you can see, it's just very obvious, isn't it? Look, you know, the buy volume, the advancing volume, far higher, the number of advancing issues far higher in both cases than we saw the day before, and the number of declining issues commensurately, and the amount of declining volume far smaller than we saw previously. And you know, we've got ratios of, well, what in this case almost 6 to 1, and even more in the case of the Nasdaq. You know, 3.8 billion shares of advancing volume plays 448 million of declining volume. So far more positive, far more risk on as far as the market was concerned, Tuesday into Wednesday. And again, the same data or similar data here, but the differences in performance. If we look at the actual composite difference, 2,444 stocks posted new highs, new 5-day highs in Tuesday's session, and 1,116 did so on a 1-month basis. So that's far more risk on, far better momentum, more buying interest, more buying power, shall we say, in the market, as characterized by these events. Still though, in the Nasdaq, there was still on the 3, 6, 52-week and year-to-date timeframes, there were still stocks posting fresh, period lows, 3 months, 6 months, 52-week and year-to-date lows. So it still wasn't one-way traffic, but the bias in the market, if you will, definitely favoured the buy side, and therefore the risk on side of the market. Now, if you don't want to take the trouble to find that data on barchart.com, then there is a more straightforward way to have a look at market sentiment and the breadth and trend in the market, and that's available from the market diary section of the Wall Street Journal. Again, this is free. A lot of their stuff is behind a paywall, but this particular area isn't. So you can find that by searching Markets Diary Wall Street Journal, and you'll be taken to this page. Again, it's a very similar setup, number of issues traded, number of issues advancing and declining, number of issues unchanged. What we also get is a comparison between the most recent closing data, the prior close, and the data from a week ago. So we're able to get a perspective from this data. And so, for instance, if we're looking here at the volume traded, you can see 977 million here, 1.2 million the prior day, and 950 odd million from the previous week. And then if we're looking here, for example, at advancing volume, we see that a week ago, just over 4 billion shares traded on the upside. On the prior close, it was slightly lower than that, 3.96 billion. And yesterday's close, well, in fact, this actually I think was Monday's close for Tuesday, just 2.5 billion shares traded. So these are the kind of data points that we can see quite clearly and use to get an impression of how the market's performing both today, yesterday, and a week previously, to get a gauge of what's happening, what the mood is, and where we're likely to proceed from there. Now, one interesting point to flag up about this page is this row here called the closing arms or trin. Now, this is another of those long forgotten indicators, but I think it's one that might, people might start looking at a bit more regularly as they try and find indicators that are relevant and speak to them about what's going on in the market. The ARMS index or TRIN index compares the ratio of advancing to declining issues with the ratio of volume of shares that are rising and falling. So it's calculated, the ARMS index or TRIN index, by taking the number of advancing issues, dividing that by the number of declining issues, and then dividing that number by the total or composite volume of the advancing issues on the day, divided by the composite volume of declining issues. And basically, when we see an ARMS reading of less than 1, it indicates that buying demand is dominant. and readings above 1 indicate that selling pressure is dominant. The reading for Tuesday's session was 0.87%, or rather I should say the reading on Tuesday morning was 0.87%. And so that showed that, as we've seen, there was strong buying demand overnight on the TRIN index. So that's another index that you can look at. Again, it's freely available. I've taken this chart from barchart.com. The ticker for the TRIN is $TRIN, but it's also available on TradingView. And those of you that use the ActivTrader will know, be familiar with the way the TradingView works. It's not on the ActivTrade platform, but you can jump onto TradingView again for free and track this index as well. I've chosen to do this in a column chart, but you could just as easily draw it in a line chart version or an area, whatever you feel most comfortable with. So the TRIN index, another way to assess what the mood of the market is. I'm not sure that any single one of these indices is the magic wand, the answer, silver bullet, if you will, to determining exactly what the mood of the market is and whether we're risk on or risk off. But I think if you're looking at some of these indicators in combination, then you can, make a good assessment, a good guess, an informed choice, shall we say, about what you think, the sentiment in the market is, and whether we are risk on an equity up day, equity up week, month, whichever, and or risk off and likely to move in the opposite direction. So thank you very much for taking the time to spend half an hour with me looking at these indicators. I hope that's proved informative and instructive. Thank you again for taking the time to spend half an hour with us here at ActivTrade, and I look forward to speaking to you all again in the not too distant future. Thank you and goodbye.